My name is Tom Anderson, Director of Sales for the U.S. at Advantage Go. And just for all those out there, Advantage Go is a next-gen software solution provider. We manage all of the life cycle, if you wish, within the insurance vertical when it comes to pre-bind, when it comes to policy admin systems, as well as post-bind, and including what we're going to be diving into in further detail today, which is the world of exposure management. You know, when you look at the last 5 years and you look at the losses that have happened, the billion-dollar losses, the increase, the incredible increase, if you wish, in billion-dollar losses across the globe. For you, Connor, when you look at exposure management and the evolution from a strategic perspective, how have you and how has the company changed or evolved your exposure management just thought process and procedures based upon the trends that we've seen over the past, 5 years from not only a primary but a secondary peril perspective?
So, from our point of view, the way we think about exposure management is we're always trying to find, as much as we can, a level playing field across all the different platforms and the different lines of business that we write. So when we think about capturing our exposures, the baseline that we set ourselves is that every deal we do, we need to have a representation of the exposure that we can use to produce a probabilistic profit and loss distribution, and that we can then correlate with the rest of the portfolio, and we can roll that up to get an overall view. What I think the last few years have taught us, on the cat side, we've clearly seen a lot of large losses. We've seen a stream of North Atlantic hurricane events making landfall, and we've seen other events in other areas as well. We've had to stick to our knitting there. So that's really, we were a cat company from the outset. So our focus there has been to try to do the things we've hopefully done well over sort of multi-decadal timescale, and just make sure we keep doing those things well, that we don't lose our focus or we don't start to change unnecessarily. I think, the challenge for us has been those large losses in other parts of the portfolio. And then, you start to talk about COVID, that's a big deal. And what we've done there is similar. So we're trying to focus on what are the things that we can do that operate across a broad reach in the portfolio that we can leverage to do a better job. So from a COVID standpoint, we weren't set up for a year-long plus global pandemic. I'm not going to lie, but what we did have, capturing enough detail about the exposure you have, capturing something in a structured form that you can then use in a downstream process is way better than just having lots of soft information kind of attached to deals. So it allows you to pivot, and that's what we had to do. We had to pivot and try and understand better our exposure to this not unforeseeable, but certainly unanticipated loss. In terms of, what is there still to do? I think really it's about refocusing on the key things that we all know we need to do. We've spent a lot of time and effort tightening up our contract wordings in certain areas. Cyber, absolutely. Obviously, communicable disease, but more generally, that focus on contract wordings, I think, is going to be really important to us as an industry going forward. And then just we're looking at ways that we can do that data capture piece more comprehensively. So we had a baseline of information, but we needed to sort of augment that as we went through this period. We're looking for technologies, we're looking for ways to improve that data capture, to streamline it, to make the structured information we capture more comprehensive, to allow us to do more things with it as we move forward.
There's so much data in the world today. There's so much data everywhere, right? I'm not looking for more haystacks, meaning just more massive amounts. I'm looking for that needle in the haystack. I'm looking for the data capture, but to make it valuable and to make it insightful so that then I can, again, like you said, I can then go and make business decisions, based upon that insightful details and that's insightful information.
Yeah, so I think every quarter and oftentimes more frequently than that, we essentially have a heat map of everywhere in the industry that we can put capital to work, and that's across lines of business and at different points in the capital structure, or whether that's collateralized RE, whether that's debt, and we really try to basically tilt the portfolio where we see the best opportunities. So we have a target allocation that might drift in the high 30% of our portfolio if we think it's a harder rate environment, or we think if there's opportunities in cat, and that might tilt down to 30% if we just don't see it, the same level of opportunity that we've seen in the past. So I think we really take a portfolio approach, and as far as trying to have a number of different loosely correlated lines of business across our portfolio, and tilt accordingly. I think from there we have a number of different funds which we invest, which all have their own particular constraints, whether or not that's allocation to a particular line of business, or allocation to a particular seed in any given particular deal. Again, we also try to use as much technology as we can to try to automate the management of those constraints, the allocation of capital to individual deals, or different industry themes that we see. And we meet on a quarterly basis to revisit those allocation percentages, how we're tracking towards target, what our pipeline looks like towards that target. And I think that really kind of drives from a top down of where we most want to deploy capital. And and then I think similar to what Connor said, we have a process driven approach. We kind of start at the back and say what types of reports and analysis do we want to do, from managing our aggregates, managing our risk, and then we look along that process of where do we capture data in the easiest ways to be able to generate the types of reports and analyses that we want to be providing, both on an individual deal basis and kind of the marginal impact on the overall portfolio when we're evaluating a deal. So I think that's kind of the way we've always looked at it, is to try to keep as as multifaceted an approach for viewing risk as we can, and that's stochastic views of the risk return profile of any individual investment. We put a heavy emphasis on event scenarios and trying to understand similar to the realistic disaster scenarios, plus augmented with some other ones that we think are important. And then of course seeing how everything fits.
And to that end, like you were saying, right there at the very end, when it comes to the deterministic versus the probabilistic, has COVID really provided that impetus for you to do, additional audits on unforeseen, like you just said there, where it's cloud outage or whether it's cyber or whatever the case? Has it, provided that, again, that impetus, if you wish, to really look at the portfolio across just, all the areas that you could be exposed to? Have you done more analysis, if you wish, based upon COVID to that end? Did that question make sense to you?
And the exercise really is, take the cloud outage, for example. You go deal by deal. You try to think of cloud outage in a kind of a baseline worst case scenario. You try to assess the impact to any particular deal that you write, and then you try to quantify that and essentially be able to roll that up. So again, it's not about the idea that you're going to be able to avoid risk if you somehow undertake these analyses. It's more so just trying to quantify what that risk is, understand that it may exist, take any steps to mitigate those types of risks ahead of time if you can.
Where is the market transitioning to? Is the Bermudian market looking to embrace the fact that this video conferencing and the staying at home and all of that is almost the new normal, if you wish? So if you could expand upon that a little bit, just kind of where the market was and where it's headed over the past year, that would be great.
Well, thanks, Tom, and thanks for the invitation to be here. So really, the investment in technology has paid off for the entire Bermuda international market. So literally overnight, all the companies went home. But more importantly, the regulator, the Bermuda Monetary Authority, a world-class leading regulator, was able to do the same. And we've kept up that weekly interaction with the regulator as they monitor international markets for us. So the real sophistication has really upped a notch, if you will, on data analytics. If you think about Bermuda's rich history in the early 90s after Hurricane Andrew and the use of analytics of how they really saved the Florida market, if you will, for affordable and accessible insurance coverage, that initial use of analytics is now up several notches of how the companies are analyzing data today, and really through the lens of matching a rate with risk. And I've heard a theme here today that folks are focused on individual deals, and I think that's what we're hearing more and more of. If you can get the individual deal correctly, then when you roll up that risk, you have more confidence that you're in a good position in monitoring risk. Investors really are taking advantage of this flight to quality, and whether it's going to quality established firms with a track record that have quite a bit of additional capital to deploy against risk at a time of great uncertainty where there's still tremendous risk in the world, but also a flight to quality on some of the startup companies. So we're seeing some of our trusted friends who have been in the industry for years and have had successes at other companies, that they are the ones with these startups. This is not a new crop of people that we're not familiar with. These are people with established careers and a record of managing risk.